Business Today Television. I'm Siddharth Zarabi and you're watching Modinomics 2024, our coverage in the run-up to the interim budget for 2024. Just hours left, and I'm joined by noted economist Radhika Rao, the ED and senior economist at DBS Bank, Singapore. We are also joined by Anubhuti Sahay, the head of South Asia Economics Research at the Standard Chartered Bank. We'll also get more views on the show, but the backdrop, viewers, for today's discussion is to get a macro picture of the state of the Indian economy. And just as we are getting into the show, two important news items that have played out over the last couple of days. One, the Finance Ministry's robust, optimistic outlook for growth at 7%, and then the IMF saying that FY24 growth in India is now seen at 6.7%, revised upwards from its October forecast of 6.3%, and the IMF saying that growth in India is projected to remain strong at 6.5% and thereabouts in 2025 as well. I'm coming to you, Radhika, to help our viewers get a sense of the overall state of the economy just ahead of the budget. Radhika.
Hi, Siddharth. So certainly, I think the economy is coming from a position of strength. I think the first half of the year, the fiscal year, growth did surprise. And I think that's why the run rate has continued to improve. And like you rightly pointed out, the IMF's upward revisions, as well as Finance Ministry's, as well as the review report that was published, all of that kind of reflects that optimism that growth would be closer to perhaps 6.87%. So our own baseline is about 6.8, but we do see upside risk to that, given high frequency numbers that we've been looking at. Now, what is driving this strength? I think it's certainly domestic engines at this point, which is behind this, optimism. First of all, where the government's spending plans, especially on the capex front. And what you've seen, of course, we speak a lot about government capex, and I think the other big engine we should be really looking at also is household capex. That really forms about 40% of the investment piece, and there too you have seen positive developments, particularly into residential, construction, and that investment cycle has taken off as well in the past year and a half. So that together with a bit of support from consumption, but certainly consumption is not doing as well as it could be at this part of the cycle. When we track some of the high frequency indicators, we look at a bit of a divergence between how urban India is doing and how rural India is doing, particularly the farm sector. But nonetheless, consumption to a smaller extent also adding to overall growth. So we would kind of agree with, the underlying stronger footing of growth that the budget is being put across. And what you're going to see here is that for the fiscal 24 number in particular, budgeted was about nominal growth was about 10.5%. The actual could be probably closer to 8.9. But we still, when we discuss the fiscal math probably later in this discussion, despite that small nominal GDP miss, we don't think that the fiscal deficit numbers are going to go awry. So we do think that the 5.9% of GDP deficit target will be met.
Okay, that's a great summation. Anubhuti, pretty much the same question to you with your own view on the likely headline growth numbers that we are going to see.
Sure. So for this year, I would say it's pretty similar to what we have been what the finance minister has been saying. So for FY24, we have a growth number of 6.8%. There is a possibility of an upside risk. Having said that, when it comes to FY25, we are a little bit more conservative vis-a-vis what our finance ministry has indicated. We are looking at a 6.3% of real GDP growth, nominal growth of 10%. Can there be an upside surprise? If we take a step back, in fiscal year 24, the street expectation was closer to 6%, and then all of us eventually scaled up our forecast towards 7%. Can we get a similar positive surprise this year, especially given that global uncertainties are significant, whether it is about soft hard landing in US or China or the increasing geopolitical tensions? I think what Radhika mentioned, domestic demand drivers can come to play and still, allow us to grow above 6% or probably closer to 7%. And that would be a resumption of rural demand. We did a very detailed analysis. And it's interesting that when it comes to consumption, almost 50% of household consumption comes from rural India. And if you look at rural India, almost 40% of their income is generated by sale of agricultural produce. Since this year was an El Nino year, agricultural produce has been hit adversely and therefore earnings are low. If next year, monsoon is normal and if income of rural India improves, we can actually see a big support coming from the private final consumption expenditure or household consumption expenditure. So we are likely to end this year on a strong note. And going forward, given the overall global outlook, I think India still remains on a strong footing, and there is a possibility of an upside surprise to our 6.3% growth number. But at this point in time, I think it's also important to remain cognizant of the risks which are hovering in the global landscape.
Radhika, the Finance Ministry said that there is scope for the growth rate to rise well above 7%. Now, one of the key elements that would support Indian growth and has in the past is the global growth environment. Anubhuti touched upon that. What in your view gives the Finance Ministry this optimism to specify and talk about 7% in multiple iterations?
Certainly, I think the Finance Ministry's commentary, it really goes to show that they do believe that the domestic engines will be firing strongly enough to offset any kind of external risks. And I think part of that also comes from the year that we are coming, fiscal 24, which we are close to ending. Here you've seen the external environment, I wouldn't say was the most friendliest. I mean, the monetary tightening has been happening across the board, India included. I mean, the RBI has also raised rates by more than 2.5%. You've also seen the global environment where while US has been strong, China has been slowing. So the Eurozone has also been middling around. So the environment hasn't been the friendliest. But I think all of that positivity is coming from the fact that domestic growth would be strong enough. And I think it is true when you look at the breakdown, like we just discussed. I think the investment cycle certainly gives us a lot more reason to believe that growth will be, I think about 6.5%. Whether in the medium term we get a 7% on average, I think will require consumption to really come back and participate in a big way. But right now, I'm certainly I think of the view that they expect the investment spending to be to pull in, started by the government and eventually the private sector participates as well. But just a word of caution and something that Anubhuti also touched upon is that in the past you have seen that the private sector tends to go slow when the global environment is not at its best. So I think from that angle, expecting and let me add here that private sector is participating at this point in parts, in the sectors where you've seen the government capex happening. But apart from that, the broader cycle uplift will certainly require the global environment to be also a lot friendlier. So I think on that front, having a US slowdown, we see a soft landing likely this year, which would be perhaps a less conducive environment for the private sector players.
Several important points there, and since you mentioned China, Anubhuti, I want to take that point with you because we all talk a lot about what is happening in the United States, and obviously there is a significant impact, but viewers, look at what is happening in China, and this has been spoken about right from COVID and up to the current time. There's a record property downturn in China, and property was very big, and some of the largest developers have completely collapsed, and there have been news developments around that as well. Trade tensions, significant problem again to do with China. Massive $6 trillion wipeout in the stock market, and we don't know where it will go. 18% down the index from the high. Now, I want to bring in at this stage Kaushik Das. He is the MD and Chief Economist, India and South Asia at Deutsche Bank. Kaushik, welcome. Both Radhika and Anubhuti spoke about some of the major headline items as far as the state of the economy is concerned. I want you to explain to our viewers the likely impact of continuing economic woes in China as far as the global environment is concerned and its impact on India's growth prospects.
So so the thing is, India is doing exceptionally well compared to the other comparable emerging market countries, and so I mean, we are going to get 7% growth in this year. Nobody thought that number would come close to 7 when we started forecasting for FY24. So India is definitely showing growth outperformance compared to any other country that you can compare, and that's a very positive thing because that puts the government in a strong wicket to do fiscal consolidation, because when growth is weak, it's difficult to do fiscal consolidation. If you get growth of 7% and you add another 4% inflation, you're talking about 11% nominal GDP growth. And this is not just for 1 year. For India, this kind of nominal GDP growth of 10.5%, 11% will continue for the foreseeable future, whereas other countries would be much lower. And therefore, we have a natural advantage given our structural, dividend, demographic dividend, and aspirational middle class. All those things will play its part. India will become a $7 trillion economy by 2030. And, in a few years' time, would be the third largest economy by size. So there's a lot of economies of scale which, investors would look for while investing in different countries. And after the two big countries of or regions of US and China, people would like to, look at India from a structural point of view. So all those help. And we have seen our Indian stock markets doing pretty well in the last 3-4 months. And, what could happen is that if there is a slowdown in the global economy, if the Chinese economy is not growing at that pace, given the trade linkages, there could be some bit of interlinkages. So our calculation is that for every 1% downgrade to global growth, whatever the starting point may be or the baseline estimates are, if there is a 1 percentage point downgrade of that, Indian growth could slow down by 40-50 basis points. So that risk is always there, that if China is not growing at a faster pace, and if the US economy and European economy over a period of time, maybe the second half of 2024 is slowing down quite sharply, then India's growth would also be affected. But even in that case, we are looking at a scenario where growth would be comfortably above 6% in real GDP terms, and in nominal GDP growth terms, which is more important for fiscal ratios or financial markets, we are definitely going to be above 10%. So it's a very good story for India in this new year compared to any other country that you can think of. And you've seen that in IMF's forecast as well. IMF has kept 6.5% growth for the next 2 years. So it bodes well for India.
Absolutely. In fact, viewers, Yashwant Deshmukh, one of India's foremost pollsters, has also come out with another report and analysis, which we'll hopefully get you later, where he said that there's a significant sense of optimism this time round, not just for the budget, but as we head into the general elections. Anubhuti, inflation under control and deficits trending lower. This is another headline that has emerged from the Finance Ministry's sort of short, truncated state of economy report ahead of the budget. There was no economic survey this year. Make sense of that statement for our viewers.
Sure. Before I get on to that statement, Siddharth, I would just like to talk about, when you questioned about can we really go back to 7%. I think at this point in time, probably we are not taking into account the force or the power which rural demand has if monsoons normalizes. And I'll give you a simple example. Fiscal year 15, fiscal year 16, these were the years where agricultural production was either muted or actually contracted. And this was the year when household spend on food declined, and effectively it shaved off 150 basis points from the headline growth number. And I think FY24 might not be any different. So even if we assume that the shave off from reduced spend on food because of lower agricultural produce earning is not as large as it was in FY15-16, but even if we get 45-60 basis points of an upside, purely because rural demand comes back, I think then the 7% number can look probable, especially if private sector investment also starts picking up, not in the first half, but in the second half. So I think these are the two positive factors which we'll have to keep in mind when we're talking about the 7% number. Coming to inflation, both Finance Ministry as well as the RBI Governor recently talked about better visibility on achieving the medium-term inflation target of 4%. I would agree. We do see 4% inflation printing for a few months in the 4% handle, but we are a little careful in terms of inferring that India can achieve a 4% inflation on a sustainable basis. Core inflation is very well behaved. And there are two drivers. One, commodity prices are very low. Global commodity prices are very low. This might not remain a norm forever. And the other part is because rural demand is weak, probably, the pricing pressure, the demand pressure which otherwise would emerge is not there. So even if core inflation remains at 460 or 470, we are extremely cautious that food shocks have become more of a norm rather than an anomaly. And that's why I would say that probably on inflation front, we think a 5% looks more probable given where growth is, given climate change repercussions, and like a little bit of an uncertainty on where the equilibrium for global commodity prices are. On the deficit, clearly current account deficit, it's a big structural change, and I think market and investors focused on India are not still fully appreciative. The doubling of services exports has clearly made India now more comfortable with an oil price of 85-90. This number used to be 70 before. So will it remain? I think even in the stress situation, we can say that current account deficit can remain under 2%, so easily fundable. And fiscal consolidation, the government has reiterated. So our sense is probably over next couple of years, we'll see continuous improvement or progress on that part too.
Radhika, you mentioned the deficit bit earlier on, and if you want to take that forward, because I also wanted to go back to your other comment about private sector investment picking up eventually, but let's start with your views on the deficit.
Certainly, ahead of the budget deficits, I think this is an interim budget. The economic actors will be looking at these, or stakeholders will be looking at the contents quite closely, though there will be a full-fledged version that will be tabled later in the year, perhaps mid of 2024. So I think some of the headlines coming out of it, first of all, would be where the deficit numbers are and what is it based on. I think we are of the view that the deficit for fiscal 24 will be met, which is at 5.9% of GDP. For fiscal 25, we expect a mix of a bit of, in the messaging will be, pre-election rhetoric plus a growth-oriented push as well. In terms of the deficit, we expect consolidation to about 5.3% of GDP. So that's about a good 60 basis points of reduction in the deficit. And that will be premised on a nominal GDP growth. And that becomes important as well, because that also determines the ability to meet or miss this target. We think it will be at about 10%. As compared to 8.9% in the year in fiscal 24. So a consolidation of about 60 basis points on a nominal GDP of about 10% is our base assumption. In terms of what will be the other contents of the mix, I think in terms of announcements, as widely discussed, we don't think there's going to be any big ticket announcements, but we should take a page off the 2019 elections where there were considerable pro-growth measures that were announced. I think from that front, we think there will be some focus on the rural community, particularly the farm community, because they have been exposed to a fair amount of weather vagaries, and that has really impacted crop output, continues to do so in the Rabi cropping as well. And at the second one, you would see some other parts, like women, for example, could be another focus area. The Prime Minister spoke about Nari Shakti earlier today. So I think there could be a couple of, in the states elections as well, you saw some financial assistance being given out to women and girls. And, and some cooking gas waivers as well. So that could be another tone that the budget could take. But I don't think these measures will really take them off the fiscal consolidation track. And I think that's the important bit to remember. So I think they will emphasize that fiscal stability is important to meet not only this year's target, fiscal 25, but eventually head towards a sub 5% of GDP deficit remains very much in view. So this we think, of course, the all-important capex cycle, how much will the capex size grow by? that will be another thing that the markets will watch out for.
Radhika,
We think it will grow.
Radhika, I want to interrupt you there. How much indeed can the capex grow, and how long can the government continue to sustain the capex bit? Because the private sector, frankly, has been found wanting in many areas.
No, certainly the million-dollar question, and I think, but the center has really taken a very strong lead, and I think they're leading by example, so to speak, and trying to finance big-ticket infrastructure projects, especially in roads and highways. And I think the disbursement slowed down a bit this year, the year we are in, but we think post-election that will pick up again.
Okay.
I think they will continue to lead the way. But private sector, in terms of policy, something like PLI has been announced, to bring particular segments on board. So I think that constructive, virtuous cycle, I think, will continue. But certainly, just a last bit that the capex cycle, the quantum, we don't think we'll see an exorbitant jump in this particular interim budget. We are scaling at about 9 to 10% increase in capex.
Absolutely. The expectations for the interim budget is that 10 years of what Modinomics has meant for the common man, pretty much for all sections of society. And it's very clear that, and within the government, the markets, and there's a sense of optimism even in the public, that another 5-year term is pretty much penciled in. Kaushik, I want to come to you on that same point with regard to capex expectations. Key headline item emerging out of recent budget, including the last one. What is your own sense? How long can the government of India continue to boost this? And at some point, do you see the private sector stepping in? There are already certain sectors where the private sector is taking the lead. For example, in renewables, where the government initiated it. But what's your own sense?
Yeah, so the private sector, as you know, in the last 10 years have been under balance sheet stress. So till 2019, they were deleveraging, and so they could not invest, and they were ready to kind of invest in 2020, but then we are hit by COVID. So 2020-21, there was this cost cutting initiative, and those 2 years also went by. 2022 is when we saw the demand coming back slowly into the system after the reopening, and 23 we have seen not a broad-based recovery, but as you said, certain sectors, certain companies have put in capex. So it's not that capex hasn't happened, but not in a broad-based manner. And now we are, into the election, season. So once election gets out of the way, I would assume that, some part of that capex recovery that we have seen in the last, 18 months or so, that will become more broad-based going forward. And, RBI probably would be easing rates in FY25. That will also be an added incentive. So if you take a little bit longer term view, say the next 3 to 5 years, would we see the next capex cycle picking up? Because we haven't seen it since 2011 or 2010 when there was this heavy investments that were done. I would say that you'll have a bigger support of capex coming from the private sector over the next 2 to 3 years. It's difficult to time whether this quarter or that quarter. Sometimes it gets postponed because of global uncertainties or some event risks that come across the way. But otherwise, if you take a little longer term view, 2 to 3 years, I think the capex cycle is coming. And that's the biggest structural positive story for India, that even if private consumption slows down because of all the rate hikes that the RBI has done and the liquidity tightening, you'd expect some bit of transmission to happen and private consumption to slow down. But if the private investment picks up from the corporate sector, and by the way, when you talk about government investment, center plus state plus public sector companies, those are about 1/4 of the total investment. The rest is, the private sector and the households. So you could have a very strong support to growth, and the quality of growth would also be good because it will be investment led, and therefore inflation could be managed in that 4.5% trajectory. Now, I think the government will still continue to push for capex, whatever limited space they have. So next year, FY25, despite it being a shorter year, if the budget is presented in July, I think at least INR 11 trillion worth of capex would be announced compared to INR 10 trillion this year, which would be about 15-16% increase. Whereas the revenue expenditure would not see that much of an increase, only maybe 3-4%. So overall, what will happen is that, or what has happened in the last 4 or 5 years is that government has tried to reduce revenue expenditure as much as possible. Certain things are committed, you cannot reduce, but the capex has gone up. So the quality of fiscal spending has improved quite a lot. And I think the thrust will continue going forward.
And very clearly, the size of the welfare state, both at the center and at the states level, continues to grow in India, and that is perhaps a big political economy reality. As we wind down the show, what I want to do is to get all our panelists to speak about some of the other numbers that they are looking forward to. It is an interim budget, but 2019 taught every single observer a lesson that the tradition of an interim budget was perhaps codified over time, but that has changed given the nature in which our politics has also evolved. So I, for one, am not expecting anything interim. I see it as a continuation, and there will be one more, perhaps an updated version of the announcements in July. So, Anubhuti, I'll start with you. Borrowing as one of the numbers that is very closely looked at, and any other number that you would like to share that you are keenly looking forward to tomorrow.
Two things. One, you mentioned borrowing. So gross borrowing from the central government level is estimated at 15.8 lakh crores. It can be lower if fiscal deficit is at 5.3% of GDP. We are looking at a fiscal deficit of 5.6. So the surprise, if any, on the borrowing number is likely to be on the lower side. Positive news. Second, I would be also focused on what assumptions the finance minister takes for tax to GDP, especially direct tax to GDP. It has seen a massive improvement versus the last year. For any economy to get to a direct tax to GDP of 6.5% versus 6 in a matter of 12 months is a big achievement. And this is just a reflection of digitization, better compliance, the AIS form, where the government or the tax department is able to track every transaction better. So better tax compliance. Can we see more of it going forward? And if that's the case, then the growth numbers on tax would be much higher than what we are assuming, which is closer to nominal GDP growth. Will she assume a much larger number? And if that is the case, that's a good news because if direct tax increases, it provides permanent fiscal buffers, and what you mentioned earlier probably provides the government the space to continue with, capex-like or productive sector-focused spend. The third part is what you mentioned, welfare. I think if not in this budget, probably we can see something coming in the final budget because Prime Minister also talked about farmer income scheme. So there can be a slight increase there, whether it happens tomorrow or in July is something which we'll have to watch out for. I would like to reiterate one thing, Siddharth here. We always, just on the back of headline announcements, we believe that the government is spending a lot when it comes to food subsidy or fertilizer subsidy or farmer income scheme. It is true, but at the same time, we also have to remember that they are targeting the beneficiaries very, very nicely. If you simply look at the farmer income scheme, the beneficiaries have been cut down by 20% in just a matter of 12 months. So the total spend might not be as large as it initially seems to be. For instance, when food subsidy was made free, last year, we all thought it would be a large number. Compare the food subsidy bill today versus what it was 2 to 3 years back, or even before pandemic, the number is smaller. So yes, there are more schemes which have been announced, but they are targeting it better. And to that extent, I would again say, that quality of spend is much better than what we used to have before. So anything on farmer income scheme, how the tax numbers are accounted for, and last but not least, the borrowing number, these are the three things which I'll be watching out very carefully.
Okay, Radhika, I want to come to you on your expectations as far as the borrowing number is concerned and any other additional data that you are looking forward to.
Thanks, Siddharth. So certainly, I think borrowing number for the bond markets in particular will be very important. We are looking at a number closer to fiscal 24. So I think 15.3, 15.4 trillion is more likely. And I think if that kind of an outcome does happen, I think that would essentially be very easily digested by the bond markets. One of the biggest tailwinds, or rather an incremental tailwind for demand for bonds comes from the likelihood that foreign investors will be willing to participate or will be able to participate in a bigger way this time around compared to the past. Essentially because of the inclusion of Indian bonds into the two benchmark indices. I think at least a 1.6 or 1.8 trillion can be absorbed by the foreign investors. So I think that will also give us a sense of confidence overall that the demand-supply mix will be favorable in the year ahead. In terms of the other numbers, I think just to reiterate, we are looking at a 60 basis point consolidation. That means the deficit comes down by that measure. I'll be also keen to know if they maintain the 4.5% target for fiscal 26. Now that means there's another sharp consolidation ahead. We need to understand where that's going to come from. So that would be the second part we're looking at. Not only the 25 target, but also 26, whether that's 4.5% is maintained. And the third aspect would certainly be in terms of the announcements. Funding part, just like Anubhuti mentioned, I think the tax revenue, for me, the buoyancy will be important. Actually, direct tax buoyancy as well as gross tax revenue buoyancy has been very strong, much above usually what it is, about 1.5%. So I think, do they assume similar buoyancy going forward? And I think that will then explain the optimism on the spending end as well. And the final bit will be, again, while we speak about how much money can they set aside for CAPEX, if we take a step back and we realize that actually revenue expenditure is still about 80% of overall expenditure. So I think materially that needs to be brought down over time, the non-sticky parts of revenue expenditure to be really consolidating finances, so to speak. So I think that will be the other aspect that we will be looking at quite closely. Again, this will just give us a glimpse in the interim budget, but I think the July one will be certainly more important.
Absolutely. And for the common man, perhaps there might be some announcements as far as their tax burden is concerned. But remember, tax buoyancy this time will perhaps make that task easier. Kaushik, I'm coming to you on that final point that we have been discussing in terms of the numbers that you were looking forward to.
So I remember last time we did this interview last year, you had asked me whether tax cuts could come or not. And that is something which the common person would kind of look out for. That's what matters the most in the budget. Now, because it's an interim budget, maybe they'll not make any major changes to the tax policies as of now, but it's always nice to see some bit of tax cuts on the direct tax front, if it is possible, given that the government is getting a lot of tax collection anyway. But let's see, maybe we have to wait for that in the July. But generally, all the things that, Anubhuti and, others mentioned, the thing is that for the market tomorrow, for the bond market, what matters is not the fiscal deficit. It's just the headline borrowing number. And market borrowing, we are expecting gross market borrowing around the same levels as last year, 15.4 trillion. So if it is something like 15.2 to 15.6, it doesn't matter for the market that much. Anything closer to 16, or if it goes closer to 15 or lower, then it will be a market moving event. We are assuming 5.3% fiscal deficit target for FY25, because the government wants to go down to 4.5% by FY26. So unless you bring it to 5.3, you'll have to do, for example, if you're at 5.5 next year, you'd have to do 100 basis points of consolidation in 1 year in FY26, which could be more difficult. So I would assume that they would try to bring it to 5.3, and it is not very difficult to bring the fiscal deficit to 5.3 in the next fiscal year, because nominal GDP growth would be around 11%. Tax collection, my calculation is, would be around 11%, taking into consideration all the upside downside risks. So it is not that difficult to bring it to 5.3%. The other things that I'll watch out for, obviously the CAPEX, what kind of number they're assuming for next year. My own estimates are probably 11 trillion would be shown compared to 10 in this year. The other things that are going to be watched out for is disinvestment proceeds. You know that this year we didn't do well on the disinvestments front. So INR 650 billion was the kind of estimates. We are hardly going to make much lower than that. So next year, what is the disinvestment proceeds? What is the RBI dividend that is expected to the government of India on the non-tax revenue front, and obviously the tax collection? And on the expenditure front, both CAPEX and revenue, what are the food subsidy amount, fertilizer subsidy, NREGA, all these would be seen more carefully by economists. But what matters for the market tomorrow is what is the market borrowing number. And if it is 15.4 trillion or lower, I think market will kind of take it positively, and that would be seen as a very positive outcome.
Just before we started, Radhika and I were discussing, and I said, this month, January month, has been, for me at least, Davos devotion and deficit. But Kaushik, you have turned that third D around and you've brought in borrowings, because I wanted to end the show by saying that from Davos to devotion and now a keen eye on the deficit, the interim budget, the second one that the Prime Minister will be overseeing in some ways, 10 years of Modinomics, another 5 years being penciled in by most people in the economy, and the key numbers that our great panel of economists have spoken about. This interim budget will be followed up with the big one in July, and frankly it will be a continuation of what Modinomics has stood for in the last 10 years and what it promises to do for the next 5 to 10 years again. I thank my entire panel for their time with us today, and you the viewer for tuning in. If you have, thank you very much for watching. We'll be back with more. Until then, do stay tuned in. Bye-bye.
Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines and many other sectors.
In today's rapidly evolving business environment, when risk is omnipresent, managing risks is no longer just about ticking a few boxes. Businesses need to maintain a panoramic view of risks to stay ahead of the curve. Join us to explore how organizations can rethink risk to unlock new possibilities and become fit for future. At PwC presents De-Risking the Future in collaboration with Business Today. Celebrate 32 years of leadership in business news with Business Today. From the groundbreaking AI cover of Sundar Pichai to PM Modi's exclusive on G20, we redefine headlines. Now our 32nd anniversary issue explores India 29, the 5-year agenda, with industry titans sharing exclusive insights. So, just BT it for unparalleled perspectives. Business Today. 32 years of leadership, innovation and business brilliance. Subscribe now.
साथियों,